Hello, everybody, and welcome to the Middle Class Investor. This is Seth Martin, your host. It is October 9th, about 11:30 p.m. I'm recording at night because I went to the Pearland Alvin football game. My son's in the band, and we go to the football game to support him. Anyway, Pearland won. It's a good game. Anyway, back here looking at the markets, and we're looking at a chart of the S&P 500 index. This is a weekly chart. As you can see here, we had a pretty strong week, actually a pretty strong couple of weeks off this September 29th low and just shot out of a cannon. You can see I've got this little green area up here where I'm showing some resistance. And I believe there's a gap a little further up here. The interesting thing about this particular chart, normally you get, I'm not going to go into great detail about Elliott wave, but basically it's a theory that says the market is patterned, and it's patterned to a certain kind of wave structure, and that wave structure looks about like this. Okay, so the market advances. What it says is market advances in 5 waves in the direction of the larger degree trend, and it corrects in 3 waves. And if you kind of, the problem is there's, people see what they see, right? So it's not a perfect theory, but you can see here that this correction here looks kind of 3-wave-ish. Now, obviously, if it goes on further, then that was a 3rd wave. But if it stops right here, then turns out it's a 3rd wave, and then the next wave would be down. Now, here is the difficulty in determining where we are at this particular time. And the market is this way, by the way. It makes it difficult for you to apply any one particular principle to it at any time. So one of the things that the Elliott wave people do is they always look at advanced declines, or they look at market internals to help them determine whether they're in a wave 4 or they're at wave 5, things like that. Now, again, I don't want to get too far into the weeds here, but the question really is, did the 5 wave down already happen, and now we're in a larger degree wave 2 up, or are we still in this first move down? And that discrepancy or whatever deals with these 2 lows right here, this low and this low right here. And you can see this low did not go lower than this low, which, it has to if this is a completed 5 waves down. So the reason I'm going into all this is because there's some uncertainty right now with exactly where the market probably is in this downward move. Now, you can't be too certain about. You always have to kind of think in terms of probability. That always exists in the market because any one day there's no telling which way it's going to go. I mean, you just have to. It can go up and go down. It literally has the same probability of going up as it does going down, but it goes up and it goes down with a certain amount of intensity that can be measured by certain market internals. Anyway, I'm getting off into the weeds here, but suffice it to say there's a little bit of difficulty at this point, at this juncture in the market, and I'm going to show you a couple other charts that should help clear things up, in my opinion. But it is my opinion, and I don't want I don't want to make it sound like there's no way it could go up any further, but now if it does go up further, you know, it's limited pretty much right through this area. Let me just go ahead and draw that. There's a whole lot of resistance through this area right here. I mean, certainly it's not going to just rocket right through this. It probably, if it did even get this high, it would probably get here and bounce down and then bounce up again. It's going to take some time to chew through this resistance if it is moving up above this. I don't think it is, but if it is, it's certainly not going to happen, you know, this week or next week or whatever. So let me show you a couple of charts. Let me show you a couple of reasons why this is at issue amongst people that kind of chart. So let's look at the Wilshire 5000. So you can see right away the Wilshire 5000 did make a lower low. See this low here, and then this low here is lower, and it made it in about the area that it would make it. So if you look at the Wilshire, you kind of got a wave 1 down, get a wave 2 up, you got this wave 3, you got wave 4, and then 5. And then the reason, again, this is at issue is because, whoops, let's erase that, that's ugly. Your first move is usually to kind of a decision area right off this high, and then you come down, and then you could get a move like that. So, and this would be the next degree. So the market is something, it's a mathematical term called a fractal. So at different degrees or at different, think of it as different resolutions. So, you know, microscopic resolution all the way up to, you know, naked eye resolution. It patterns in the same way. So if you were to zoom in, it looks exactly as it does on a minute chart as it does on a daily chart, and so on and so forth. So anyway, again, what's at issue here is the fact that this made a lower low. Now another market, the Russell 2000, also made this lower low. So you can see here this low here, and then we made a lower low here. So it's patterned kind of this way. Now let me show you. Oddly enough, the Russell's a major index, and the Wilshire's a major. They're all major indexes, but you just don't hear that much about the Russell or the Wilshire. But if you look at the Dow Jones Industrial Average, did not make a lower low. And if you look at the NASDAQ, let's look at the NASDAQ Composite, did not make a lower low. If you look at what else do we have? The Dow, I guess the S&P, that's really about it. And also, I've talked about this before, but on the S&P 500, if you look at the futures, this was quite a bit lower in the pre-market trading hours, and we'll look at that right now, and I'll show you what I'm talking about. So you can see here how much lower, how much lower this went relative to this one. I mean, look at the angle here. I don't know, what is that, about 40 degrees, roughly 40 degrees. And if you look at the S&P 500, I mean, what's the angle here? Like more like 15 degrees or something, 10 degrees maybe. So this low went much lower in the pre-market than it did in the cash market. And that's also got people kind of in dispute about, what's actually going on. Now, I'm going to show you something else that I look at, but we have to go down to a smaller time frame. So I realize that, If you're in a 401k or you're in an IRA, you don't really care about a 60-minute chart, but I'm only showing you this just to demonstrate why I think we're very near the last part of this last run. So if we go back to this kind of move here, this up, down, up, this is back from the earlier part of September. This graph down here is what's called a MACD. It stands for Moving Average Convergence Divergence. And this is an oscillator that all oscillators, all indicators work off price action. So they have price in their formula that derives this curve. And so by definition, they lag the price action in the market. But you can get some general idea about the internal strength of the market sometimes by looking at these oscillators. And if you notice, we had a high right here, and then right here we had a higher high. And if you look at the MACD, we had a high and we had a higher high. So high, higher high, high, higher high. But then if you look at this high, and this high is clearly higher than this high, but now all of a sudden in the MACD you can see this low, the MACD came up and made a lower low from this low, or from this high right here, a lower high, excuse me. So it made a high, it came down, it came back up and made a lower high before the market rolled over. And so this is what's called a divergence in the market. So we got some internal momentum diverging from the price action. And if you look over here in this most recent move up, we have a similar situation. We have a high, and then we have over here we have a higher high. These series of highs right here are higher than this high here. But then look at the MACD. The MACD has a high, and then it made a lower high. So it's diverging internally. So what that tells me is that this market is running out of steam pretty rapidly. It looks like it already has. Now, it doesn't mean that it couldn't go up and make a new high. You know, I've got this resistance area right here. So the market could come up and make a slight higher high, maybe just above this old high here, and then start pulling back. But clearly there's a divergence here in the MACD, and I think it's definitely worth mentioning, which is why I mentioned it. But it's an important aspect of the market that if you're a technician, you can't ignore that type of stuff. So let's go back to the profit charts. Let's look at the interest rate. So this is the 10-year Treasury interest rate. And this week we have an inside week. So it was an up week for rates, but not an overly aggressive up move. But it does look like we've made, you know, if you look closely here at the yields, it looks like we've made, you know, kind of a double bottom here. I mean, those probably aren't exactly the same, but in fact, this one's slightly higher than this one. So you've got to pull back into a higher low, and then right here, this is an inside. Well, normally we talk about an inside day, but this is an inside week where the body of this candle is inside the body of the previous week's candle. And so, what does that tell us? Well, from a candlestick perspective, if we get a close next week that looks like, you know, as long as the close is above this high, so as long as we get a close above this high right here, that high right there, then it means likely, again, probably, high degree of probability that this particular downtrend is over and that we're going to resume the uptrend. So look for rates to move higher next week. They might move lower initially. You know, you might get a you know, something like an open right here, let's say, and then a run down to there, and then a run back up, you know, to here with a close up here somewhere. So In other words, you have to wait till the end of the week to kind of see what this pattern holds for us. Okay, let's go to let's look at the Euro US dollar. Obviously, a lot of eyes on that market these days. The euro kind of spiked up here. We can see into this decision point area where I kind of made a box off of this previous high right here, and that's where that box came from. We ran right up and spiked up into it, almost like a little blow off top, and then immediately sold off, chopped around a little bit. It looks like the euro, I've been saying this now for a couple of weeks, but it looks like the euro wants to go lower, and I would expect in the next several weeks for that to begin happening, and probably see the euro take out these lows back here from March and get below this 105 area. Let's see here. Let's look at volatility. Volatility was it was most surprising to me this week because, well, I don't know, we had a very strong week, so it's not that surprising, but I really thought this trend line would hold. But volatility it doesn't chart as well because it's like a derivative of a derivative. So it's really not something you chart anyway. You just kind of look for zones. We're kind of back in, if you want to think of it in terms of zone, we're kind of back into this space here. I doubt volatility is going to go back down into this area. It'll probably stay in here, although it doesn't have much room to go much further before it gets out of here. And you could get volatility kind of excursion, slightly out of this area, and then, start making its way back up, kind of a deal. But volatility definitely, I mean, look at how much volatility has collapsed out of the market. I mean, prices for options have gotten cheaper. So you probably once volatility starts coming out of the market, that's usually a sign of complacency, and it's usually about the time the market whacks you pretty good. So getting back to our S&P 500 chart, we're probably at or very near the end of this little upswing, and I would look for the markets maybe early, maybe Monday you get a little pop up from here, not too much, maybe 2025, maybe 2028, something like that, and then start carving out some moves to the downside like so. And it should be pretty rapid. I mean, now, having said that, the move back up is going to be very rapid as well. So you're going to see volatility spike pretty good on both sides of the market, down and up. So the market internals were very good this week, but there's been other times that they've been good, namely back in 2007, we had this move. When you kind of zoom out, you can kind of see this. Broke the trend line, and it's kind of going back up. And look here, same kind of thing. We kind of broke down. You can see the wave. I was talking about the wave pattern. You can kind of see it here: 1, 2, 3, 4, 5, right? And then this move right up here. This move right in through here. Let me zoom in just a little bit. Well, did I lose it? Okay, this move right here. The A to D, the advanced declines were pretty high. I mean, they were spiking pretty high here and here and in here. So just because the advanced decline line is the internals there are good, doesn't mean that we're off to the races in a new bull market. I mean, this pattern creation is super important, and why it works, who knows, but it works. So you can kind of see here. Let me zoom in a little bit. I'll kind of draw it for you here. Now, sometimes it's not a perfectly, it's not all going to fit there. Let me zoom back out. Where was I? Right here. So you can kind of see here, maybe this is 1, this is 2, whoops. I really like my other drawing tool better, but I have to zoom in, and I've got so much price action here, it's hard to zoom in on all of it. But you can see here we got 1, 2, 3, 4, 5. Okay, and then if you go over here a little further, this is again hard to see. I'll give you that. I mean, these Elliott wave charts, these patterns are super hard to see. In fact, my personal opinion is it's impossible to trade just about using that. But if you step back and look at the big picture, you can kind of see the patterns. Now, each one of these moves has, patterns in it. So you have to, if you're really plotting all this, you have to count every single thing. But in general, you can see another clue to telling whether or not it's a, whoops, sorry about that. I'm not getting control of my. If I take this first move here and I put a channel around it, so right here down to here, see how it accelerated out of the channel? This is pretty typical of what they refer to as an impulsive move. So just to contrast that, if you look at the counter trend move up here, so this would be the counter trend move. Let me put a channel right through here. You can see how that's all contained within the parallel lines, and that's one of the ways you tell whether you're in a, what the direction of the trend is. So if you look at over here at our recent move down, and I take the high and the first kind of this here, I'll just do it and show you. So if I take the high and I connect it to the next high, and then I come down and connect these first couple of lows here, see how it accelerated outside the channel? That tells us, what that's telling us, and this is the part I'm talking about where Elliott wave is actually pretty good, even though it gets a little bit of a bad rap in the investing world. That tells us that the direction of the trend is this direction, down and to the right. And then this is all counter trend. Now, so if you're in a 401k or an IRA and you're seeing, wow, the market's moving back up and I'm not in it, you just need to sit pat because this thing's going to roll back over and go down. So, and again, it's possible for it to come up into, probably pull back first and then come up into this area, but it's not likely to make a higher high. This move right here is pretty definitive that the impulsive price action is down and to the right. So I know these counter trend moves can be pretty violent, and you look like you're probably thinking I should be in the market if you're not in it. But I just want to put your mind at ease and let you know that probably by the middle of the next week, this is going to be headed back down. So, but I said probably. So what does that mean? That means there's also a probability that that's not correct. And I just want to be real clear about that, because In fact, if anybody tells you, you hear people on TV or whatever, and they're talking about the direction of the market, and I mean, just remember that's their opinion, okay? And you know what they say about opinions, everybody's got one. So, but what they really need to be prefacing their opinion with is the probabilistic nature of the market, and therefore their opinion also has the probability associated with it. So, anyway, let's look at the dollar index. We didn't look at gold. Let's look at gold real quick. And it's very busy. I need to get rid of some of this stuff. Probably should have done that first. Gold, we have this really long downtrend that started back in 2012, I think. And off of this low here, we drew this box, and the market came down and touched the box, and it rallied up, and then it pulled back, and now it's rallying back up, and it looks like to me that we're probably this time going to break the downtrend. We put these lines in here a while back, and probably need to change them and pull them out this way. And it looks like to me that we're going to probably break through this downtrend line and head out in the upward direction, probably up into this box that I have drawn here. So look for gold to move into this area. Let's see what that area is. So we can, around 1350. Possibly it could come. Possibly this pivot right here could be the pivot that's of interest, or even this one. So we could go minimum. We're going to go 1350, and then on the higher side, you might look for like 1470, 1480, something like that. So certainly it's going to go here first, and then it might pull back, and then it might bust up in here to around 1480. So we'll look for that to happen on gold. Again, the interesting thing is the dollar. I get maybe it wants to pull back further. It looks like it wants to pull back a little further, but the dollar looks like it is wanting to move higher from here as well. So I know those don't typically move in the same direction. If the dollar goes higher, usually gold goes lower. But the dollar's been in this trading range now for a while. And really, to be just, I guess, consistent, the best way to be consistent about this is really say, until the dollar breaks out of this area right here, up above here, it's hard to really, it could chop in here for a long time. So it's really hard to say what the direction of the dollar is going to be until it breaks out of this 98.50 range. And then maybe we can glean a little bit more from the US dollar. I wanted to show you another piece of evidence. This is from NinjaTrader. This is the MT Predictor software that I use. And you can see here we're getting a sell signal here at about the place that we would expect to get a sell signal. Now, if I put a DP off of this right here, which it's not working, there it goes. You can see that the market potentially could go a little higher into this zone here, and then have a sell signal. Now, the reason I bring that up, let me show you why. Down here is what Steve calls the strength band. And you can see this gray line here, and see how the little histogram is outside of this gray line. It's actually above. That usually means that the market's got some strength here. There's some internal buying pressure still, which I know conflicts with what I told you earlier about the MACD. But it doesn't mean that that's a lot of buying pressure. It just means that you could have a situation where you could have a situation where early next week the market pulls back a little bit and then rallies up into this decision point and then rolls over. Okay, so that's all I'm saying is that strength band, when you see that, it usually means that there's probably more upside, but there could be some downside first and then upside into this decision point. Excuse me. So, if you're trying to map out, if you're trying to plan a roadmap for next week, I would say Monday is you're probably gonna see futures down on the open, just a guess, and then reverse pretty early in the morning and probably trade up all day and maybe even into Tuesday. And then probably midweek next week, we'll start to see some weakness develop in the market and roll over. So, and that could take a couple, 3 weeks down into this area. Max, probably. That's on the high side. So that's what I'm looking for next week, and probably trade accordingly. But I'll be watching it close because if I'm wrong, I want to be wrong quickly and cut my losses. So it's just certainly the market is overbought right here and could experience, and most definitely will experience, some downturn next week. The question, though, is the real question is the downturn going to be, like this, or is it going to stop? Because here's what it could do. It could stop right here and then proceed to make a significant high above this high. In which case, if you're short the market, you don't want to be in there through this because you're losing money, and psychologically it works on you and so on and so forth. So anyway, that's what I see this week. I know I sound a little less confident. I'm definitely feel like the market is oversold. I mean, we're probably less than 20 points from a high here. But what I'm trying to figure out is that when it does pull back, is it going to pull back, a half or a third of the way down this and then rally, or is it going to? And what I'm going to be watching is the advanced decline data on these pullbacks, and if you're seeing a lot of decline in the market on those days that it pulls back, then this is likely going to follow through all the way to the downside. If the advanced declines are fairly low, then this is probably going to find some support here in the mid area and then rally to higher prices. But not a new high, just higher prices. Something up here around 2050-ish, 2060 max. All right, everybody, that's it for this week's Middle Class Investor. I've rambled along probably because it's nighttime and just tired and have football tired. So that's it for this week. You can follow me at Investor Class on Twitter if you like. Obviously, watch the YouTube channel, copy the link, paste it into an email, send it to your friends and family. Things are going to get interesting, I promise you. We're just in the very early stages of this, and just stay with me, and we will help you manage these treacherous waters that are going to be the financial markets here in the up and coming weeks and months. Okay? Take care, everybody. Have a great weekend. Bye-bye.